Welcome to Learn with Kern, brought to you by Softlogic Stockbrokers. Today, we are diving into lesson 3, and this one is all about separating fact from fiction. We are going to bust some of the biggest myths about investing in the Colombo Stock Exchange. Myths that might be holding you back from taking that very first step towards growing your wealth. And once we have cleared there, we'll shift gears and talk about something every smart investor should know: the real risk of investing in the CSE, and more importantly, how you can manage those risks and come out ahead.
You need millions to invest.
Absolutely not. Today you can start with as little as around 10,000 rupees, sometimes even less. Thanks to online trading platforms and mobile apps, the Colombo Stock Exchange is now open to everyone. No matter where you are, how much you must start with. And here's the real secret. Wealth in the stock market doesn't come from putting a massive lump sum once. It comes from consistent investing over time, steadily building your portfolio, and letting compounding do the heavy lifting.
I'm not a finance expert.
You don't need to be a financial expert to start investing. That's exactly why this channel exists. With easy to use tools, mobile apps, and clear guidance, anyone can learn the basic and confidently grow their investments.
It's only for people in Colombo.
That's a thing of the past. These days, no matter if you are in Jaffna, Mathura, or even overseas, you can open a trading account online without ever stepping into a broker office. Thanks to technology, you can buy and sell shares in the Colombo Stock Exchange using your phone or laptop. So location is no longer a barrier. Anyone with internet access can become an investor.
Foreign investors control everything.
While foreign investors once dominated the market, that's no longer the case. Today, local investors like you play a major role in the daily market activity. Your influence is strong and it continues to grow.
The stock market is only for speculators or gambling.
A lot of people believe that investing in the Colombo Stock Exchange is all about chasing penny stocks or trying to make a quick buck by flipping shares. But that's not the whole picture. The truth is, the market includes strong, well-established companies like John Keel's, Commercial Bank, HNB, and Tobacco that have been providing steady returns and paying dividends to shareholders for many years. Investing here isn't gambling. It's about owning real business that grow and create value over time.
The market is rigged for big players.
It's true that large investors can sometimes influence short-term price movements, but don't let that discourage you. With good research and focus on the longer term, small investors absolutely can succeed in the Colombo Stock Exchange. Plus, the Securities Exchange Commission and the CSE themselves keep a close eye on trading activity to help ensure the market stays fair and transparent for everyone.
If the economy is bad, you can't make money.
That's not always the case. Even during tough economic period, some companies continue to perform well, especially those in sectors like exports, plantations, and business that earn in foreign currencies. The key is to focus on industries and companies that are less affected by local economic challenges. With smart choices, you can still find opportunities to grow your investments.
Only IPOs make money.
The truth is, some IPOs do give quick gains, but many others fall below their issue price after listing. That's why it's important to do your research before investing in any new company coming to the market. Don't just jump into because it's new. Understand the business, the risk, and the potential first.
Get rich quick.
Some people hope to get rich overnight, but experienced investors know the truth. Building wealth takes time, patience, discipline, and smart decision making.
Just follow the hot tips.
The problem with tips is by the time you hear them, the best buying opportunity is usually already gone. That's why it's important to always do your own research and verify the information before making any investment decisions. Don't rely solely on rumors or hearsay.
Past performance predicts future returns.
People often think that if stocks have performed well in the past, they will continue to do so. But the reality is, things change. New competitors show up, rules get updated, and the economy shifts. So a company past doesn't guarantee it will keep winning. It's always best to check how the company is performing currently before deciding to invest.
It's too risky. You can lose everything.
Some people think investing is unsafe because they might lose all their money. But losing everything usually only happens if you put all your money into one company that doesn't do well. By spreading your investment across different companies and sectors called diversification, you can significantly lower your risk. Investing always involves some risk, but with smart choices, you can manage it well. And finally, myth number 13.
Only young people should invest.
Many think investing is just for people in their 20s or 30s, but the truth is, it is never too late to start. While starting young helps because you have more time to grow your money, people of any age can benefit from investing. Older investors might focus more on safer, income generating investment, but everyone can make a smart choice to improve their financial future. Now that we have cleared up those common myths, let's turn our attention to something equally important: the real risk involved in investing in the Colombo Stock Exchange. It's important to understand that while investing offers great opportunity, it is not without challenges. Knowing these risks, and more importantly, how to manage them, will keep you make smarter decisions and protect your investment. So let's walk through the key risks you might face and practical ways to handle each one.
Market volatility.
Stock prices can move up and down quite sharply, sometimes in response to breaking news, political changes, or global events outside our control. The good news is you can manage this risk by thinking long term. Instead of reacting to every market swing, stay focused on your investment goals. Also, spreading your investment across different companies and sectors helps smooth out those ups and downs, so your portfolio isn't overly affected by any single event.
Company-specific problems.
Sometimes a company share price falls due to poor management decisions, declining profits, or challenges within the industry. To protect yourself, it is important to do your homework before investing. Look into a company's financial health, leadership, and market position. And don't put all your money into one company. Spreading your investment across several businesses help reduce this risk.
Economic and political uncertainty.
The Sri Lankan stock market is sensitive to fluctuations in currency exchange rates, interest rate change, and shifts in political landscape. These factors can cause market instability and lead to unpredictable movements in stock prices. To manage this risk, consider investing in companies that generate a substantial portion of their revenue from abroad, as they are less vulnerable to local economic and political challenges. Additionally, sectors like fast-moving consumer goods, which provide essential products, tend to be more resilient during periods of uncertainty and can help stabilize your investment portfolio.
Liquidity risk.
Some stocks don't trade frequently, which means it can be difficult to sell them quickly when you need to. This low trading activity may lead to delays or sales at less favorable prices. To manage this risk, always check the daily trading volume of a stock before investing. It is also wise to keep a portion of your portfolio invested in shares that are actively traded and easy to buy or sell at any time.
Emotional decision-making.
Emotions like fear and greed can cause investors to make poor choices, such as buying stocks when prices are high and selling them when prices drop. This often leads to losses or missed opportunities. To avoid this risk, stay disciplined by following your investment plan consistently. Resist the urge to react impulsively to market rumors or short term news. So here's the truth: the Colombo Stock Exchange, like any market, has its risk. But these risks are not a reason to stay away, they are a reason to be smart. If you understand the myth, respect the risk, and follow a clear, disciplined plan, you can invest with confidence and build a lasting wealth. And that's what Learn with Kern is all about, helping you make informed, confident investment decisions. Stay tuned for lesson 4, where we'll break down the common jargon used in the Colombo Stock Exchange and make it easy to understand.